We have got some numbers here, so we can play with the numbers a little bit. We've given a guarantee on behalf of a charitable organisation. The charitable organisation is borrowing the money. So the charity borrows 80 million. I am Tiger, I am not borrowing 80 million. But what I do is I guarantee the loan. So I say to the bank, if the charity defaults, the charity's income is going to be uncertain. Because the charity's income is going to be down to applying for grants, fundraising. So the bank might be reluctant to lend them the money. So I come along and I say, I'll give you a guarantee, I'll give the bank a guarantee. Now that means that the bank will lend them the money, and maybe at a slightly cheaper rate, because the bank has slightly less risk. So it's the sort of thing that could happen, that we give a guarantee. Now when we give that guarantee, no money changes hands. I go to the bank and I give the guarantee. And I don't expect the guarantee to be honoured. So when I think about it in terms of ISA 37, when I think about it in terms of provisions, it's contingent liability, it's unlikely, it's possible, but it's a nil recognition. I don't think I'm going to have to pay the 80 million out. Now the loan relates to new premises, and the loan is for 4 years, and the loan is being repaid 20, 20, 20. So in 4 years' time, the charity will not owe the bank any money at all. So in 4 years' time, my guarantee can't be called upon. So my guarantee only lasts 4 years. For the first year, it's a guarantee of 80. For the second year, it's a guarantee of 60. For the third year, you can see that the loan gets repaid. Some clever subjective calculation has been made which says that the fair value of the guarantee is 12. The fair value of an asset is how much you would receive if you were to sell the asset. The fair value of a liability is how much you would have to pay to pass on that liability. So an insurance premium, if you like. So there's a judgment being made that there's a fair value of 12 million, and presumably that is a reliable measure. The guarantee is to be measured at fair value through P&L, of course. Now Tiger then becomes aware that the charity was having financial difficulties and hasn't paid the second instalment. So the first instalment's been paid, but not the second. So they've reduced it down by 20. So the liability is no longer 80, the liability that the charity have is 60. But it's at this time we get called upon, because it is now highly probable that the guarantee will be called upon, and I therefore think that the fair value of my liability is now going to be 60 as a result. You may assume that discounting is immaterial, so we can just concentrate on the ideas, and the fair value of the guarantee is higher than that under ISA 37. They want to know the principles. So when we're giving a guarantee like this, the guarantee has to be initially measured at the higher of the fair value, and the amount measured under ISA 37. Yeah. So, Tiger has given a guarantee to a bank in respect of the charity's loan. Tiger has given a guarantee to a bank in respect of the charity's loan. This instrument is measured higher of fair value and the amount per IAS 37. Given it is only judged possible it is per ISA 37 a contingent liability. Tiger has given a guarantee to a bank in respect of the charity's loan. This instrument is measured at the higher of fair value and the amount per International Accounting Standard 37. Given it is only judged possible, it is, per ISA 37, a contingent liability. The fair value on initial recognition is 12. The fair value on initial recognition is 12. So the fair value on initial recognition is 12. Debit, credit. Is it 12? Yes, it is 12. Yeah, that's the initial fair value. I need to listen now, and I need to think about two things. First of all, where's the debit? If I've recognised the liability, I've credited the liability. Where do you think you would debit? What's your intuition? If you see a liability and the liability goes up, what's your intuition? We're not having to make a payment of 12. Either we make a payment of 80 or we make a payment of nothing, but the fair value of the liability has been assessed at 12. So when you're making a debit, there are 5 elements. 2 elements are debits, 3 are credits. So the 3 credits are liabilities, income, and equity. And the 2 debits are expenses and assets. So if you've given a guarantee and the fair value of the liability is 12, do you think you've just created for yourself an asset or an expense?
Expense.
It's an expense. And where should you charge the expense to? P&L. Absolutely correct. It's logical. Not too difficult. So we have a P&L expense of 12. Next, tell me the life story of the 12. Tell me what's going to happen to the 12. In the event that the charity is solvent, and in the event that we do pay, the charity does pay its money off over the 4 years, in 4 years' time, the fair value of that guarantee will be 0. So what should we do every year?
Charge to P&L.
Yes, write it back to P&L. So on an annual basis, the loan will be repaid. Yeah, a quarter of the loan will be repaid. And therefore, on an annual basis, we will be able to transfer, reduce the fair value of the liability, and write it back to P&L. So, full stop, leave a space, new paragraph. The fair value on initial recognition is 12, and expense. The fair value on initial recognition is 12, and expense. The higher of fair value and the amount per ISA 37. The fair value on initial recognition is 12 and expense. The loan is due to be repaid in equal installments. The loan is due to be repaid in equal installments over 4 years. As such, the fair value of the guarantee. As such, the fair value of the guarantee also will systematically be reduced. So the loan is due to be repaid in equal instalments over 4 years. As such, the fair value of the guarantee will also be systematically reduced. So there will be an annual transfer, there will be an annual write back every year, and the amount of the annual write back every year is going to effectively be 3. So every year you will debit the liability by 3, and you will credit the profit and loss account by 3. So, after 1 year, the fair value of the liability will only be 9. Now, ideally, this situation occurs year after year after year, and therefore, ultimately, after 4 years, the fair value of the liability is nil. However, we now know that the only payment made was the first year. And therefore, the question says, somewhere, that we become aware that the charity was having financial difficulty and that it hasn't paid the second instalment. It is assessed, it is highly probable the guarantee will now be called upon. So therefore, given the default of the charity, the fair value of the liability is 60. And therefore we've got an extra expense to process. After only making one capital repayment, it is assessed highly probable. After only making one capital repayment, it is assessed highly probable that the guarantee will be called on. i.e., the fair value is 60. So the fair value of the liability is now 60, which is 80 minus 20. The carrying value of that liability is 9, and therefore we have an extra cost, therefore we have an extra charge of 51. We are looking at fair value through P&L. And it's slightly frustrating because I have spent longer talking to you about fair value through P&L liabilities than I have amortized cost. And yet the truth is that in the real world, 99% of liabilities are at amortized cost. But sometimes the examiner and the exam doesn't quite reflect the real world. Now, have I just done these numbers a bit too quickly at the end? Yeah? I've guaranteed 80, 20's already been paid. So when my guarantee is called up, I'm going to have to pay them 60, so I will have a liability of 60. The liability is already existing in my books at 12, but I've written back 3, so therefore the carrying value of my liability is 9. As a result of having a liability of 9 remeasured to 60, that creates a charge of 51.
Yeah, okay.